The Intelligent Investor by Benjamin Graham. Investing is simple if you take the time to learn it. Investing might seem complex, but it's quite straightforward once you learn the basics. Let's take inspiration from Benjamin Graham, often referred to as the father of value investing. He, along with Jason Zweig, has been a guiding light for new investors, teaching them to invest with thought and care. But do you need to be a financial whiz to start investing? Absolutely not. In fact, you might just become more knowledgeable as you grow your investing skills. So, what is an investor? It's anyone, be it an individual or a firm, who puts money into something with the hope of making more money in return. Investors use various financial tools to earn returns. Their goals can range from saving for retirement, funding education, or simply growing their wealth over time. An investor is someone who takes calculated risks for financial gains. An investment is an asset bought after careful research to generate an increased monetary return or appreciation in the future. Benjamin Graham and Jason Zweig go deeper and offer more insight into investing. Let's look at two terms commonly used in stock exchange trading. An investment ensures the security of the invested capital and the promise of profit. Speculating neither assures the safety of your money nor your profit at the end of the investment period. So, an intelligent investor focuses on opportunities that bring rewards in the long run. In contrast, a speculator is more interested in quick, short-term gains. This summary aims to help you understand these differences and encourages you to do your research before investing. Most importantly, you'll learn how to choose wisely among various investment options. People who invest make money for themselves. People who speculate make money for their brokers. Benjamin Graham. To avoid losing money, the intelligent investor makes decisions based on extensive research. Investing isn't just about how smart you are. It's about having the right character and soft skills. It doesn't matter how high your IQ or SAT scores are. What really counts in investing is your patience, discipline, eagerness to learn, and emotional intelligence. Smart investors don't just pick any stock. They take their time to research a company, looking at its past performance and ensuring they're not setting themselves up for financial loss. They focus on long-term goals, choosing stable stocks over risky speculation. While investing is a solid path to building and maintaining wealth, it's often overshadowed by the high-stakes speculation played by Wall Street's big players. They downplay traditional investing, preferring the high-risk, high-reward game of speculation. Speculators often make impulsive decisions, lured by recent success stories. But like in gambling, the odds are usually stacked against them. Casinos and gambling houses thrive on this allure of quick riches, knowing well that they have the upper hand. Unfortunately, many people fall into this trap, pouring in their money hoping for a big win, only to end up disappointed. Gamblers rely on luck, but smart investors rely on calculated risks. Investing is reliable and will continue to be so. The intelligent investor understands this and stays ahead by making informed decisions. But what about when the market hits a rough patch or inflation kicks in? How should smart investors respond to these challenges? Inflation is when the value of money drops, often due to increased money printing or a large influx of cash into the economy. This devaluation affects the stock market, as the value of your shares might decrease. So what's the best move for an investor during inflation? The key is to buy more stocks when their prices are low. This way, when the market recovers, you can sell them at a higher value and make a profit. Smart investing, navigating bonds and market trends. Investing smartly means staying ahead of market changes, and understanding bonds is key. A bond is essentially a loan you give to a borrower, like a government or corporation, in exchange for regular interest payments. Bonds can be a safer option compared to the unpredictable stock market, but they come with their own risks. Smart investors view bonds as a part of their investment mix, not the only choice. They might even explore foreign bonds for potentially higher returns, though this comes with greater risk. Bonds offer an alternative to stocks, but approach them with caution to avoid unexpected issues. You might hear advice to invest in every new company's initial public offering, IPO, but this is often speculative and risky. It's not easy to predict which startups will succeed, and wrong choices can lead to significant losses. A savvy investor picks IPOs carefully, without feeling the fear of missing out that less experienced investors might feel. They understand that chasing the next big thing can lead to poor decisions and losses. Investing without thorough research is a recipe for failure. A common strategy is to hold stocks and sell them when they're high, then switch to bonds until stock prices drop again. But predicting market movements is nearly impossible. That's why experts like Benjamin Graham and Jason Zweig recommend diversifying your investment portfolio. This means spreading your investments across different types of assets. However, when it comes to diversifying, be cautious with foreign stocks. Investing heavily in them might expose you to risks associated with foreign currencies, potentially undermining the stability provided by your own country's currency. Fun fact: the first major speculative bubble recorded was the 17th century Dutch tulip mania. Prices for certain tulip bulbs skyrocketed before collapsing, leading to financial ruin for many. While it's often portrayed as a dramatic crash, recent studies suggest its impact might have been exaggerated. Being an investor requires a lot of research and practice. Becoming an investor doesn't require special training or certificates. Anyone can step into this role with enough research and the right guidance. If you're interested in trading stocks and funds, here's a beginner-friendly guide inspired by the insights of Benjamin Graham and Jason Zweig. 1. Long-term vision. When choosing a company to invest in, focus on its long-term objectives. What are their future plans? 2. Management quality. Examine how the company's management operates. If they prioritize hefty payouts to themselves over company growth, it's a red flag. 3. Financial stability. A company's financial health is crucial. Investing in a financially unstable company is risky and could lead to hard-to-recover losses. Don't forget to also check the company's dividend history and its recent dividend reports. If you need more specific considerations before choosing a company to invest in, the following should be helpful. Steer clear of companies valued at less than $2 billion. Look for companies whose current assets are double their current liabilities. Choose companies expected to have consistent stock earnings for at least the next decade. Prefer companies that have a solid track record of paying dividends for at least 20 years. Ensure there's been at least a 1/3 increase in per-share earnings over the past 10 years. The company's share price should not exceed 15 times its earnings from the past 3 years. Investing is about being observant and committing to continuous learning. With these guidelines, you can confidently navigate the stock market, aiming for maximum profit and minimal risk. Investing may seem daunting at first, but it becomes manageable with dedication to research and practice. Invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Benjamin Graham. The entrepreneurial investor is an informed investor who takes risks. Investing smartly turns your income into investment capital, which will constantly bring a certain profit. In other words, you will make your money work for you. There are two types of investors. The enterprising investor, bold and willing to take significant risks. The defensive investor prefers a more cautious and hands-off approach. The enterprising investor distinguishes themselves by not solely relying on standard stock-picking guidelines. Their approach involves a higher level of engagement and a willingness to take greater risks. This type of investor actively manages their portfolio, constantly monitoring and adjusting their investments in response to market changes. Regularly rebalance your portfolio, ideally every 6 months, to make informed decisions and ensure it aligns with your goals. For the enterprising investor, the initial step is closely observing market trends, identifying potential winners, and tracking them as if real capital were invested. This investor typically prefers companies managed by their owners rather than external managers, as owner-managed companies often have interests more closely aligned with those of the investors. However, it's essential to focus on the company's actual financial performance rather than the promises or statements of the owners. An important aspect to consider is the financial health and yearly earnings of a company. Long-term profits are more likely when investing in financially stable companies. Convertible bonds are also a notable option for enterprising investors. These bonds provide the flexibility to convert into stocks or other securities, allowing for portfolio diversification and a hedge against market fluctuations. However, it's important to be aware of the risks. If the market or underlying stock underperforms, convertible bonds can be disproportionately affected due to their multiplier effect. In conclusion, the enterprising investor is characterized by their active involvement in investment management, a readiness to undertake calculated risks, and a sharp focus on market dynamics. By adopting these strategies, they navigate the investment landscape, aiming for substantial returns while staying mindful of the inherent risks. The wise investor selects the best bargain from a variety of possibilities. Choosing the right stocks to invest in is crucial, but it's also easy to be swayed by emotions or misled by appearances. Benjamin Graham and Jason Zweig highlight the importance of discernment in investment, cautioning against being drawn to companies based on emotional appeal. A catchy slogan or a company's values might evoke positive feelings, but making investment decisions based on sentiment is a mistake. Decisions driven by emotions often lead to poor investment choices. It's also a common trap to think you've found a winning pattern in the market based on a few successful guesses. However, this belief is misleading and can be harmful to investors, as there's no such thing as constant gain in the stock market. Public opinion can heavily influence investment choices. Just because a company is popular or considered groundbreaking doesn't automatically make it a wise investment. Do your own research and resist the urge to follow the crowd. Intelligent investors understand that even expert analysts can be wrong. Sometimes, it's better to consider the insights of business owners themselves. Some companies openly admit their current profitability challenges and future uncertainties. A careful examination of the market might reveal the top performers at first glance. However, a deeper look is necessary, as initial evaluations don't always show the complete picture. The success seen today doesn't guarantee future performance. Instead of going for the most popular or highly valued companies, consider investing in less glamorous ones that offer steady returns. These companies might not make headlines, but they show consistent growth and stability. In essence, understanding the principles of value investing can protect and grow your portfolio. Investing isn't just about making moves. It's about making the right moves at the right time. Choose wisely, not impulsively, and focus on solid, long-term gains over flashy, short-term promises. Conclusion. Investing might not be instantly gratifying, as it often takes time to see returns, yet it's far more reliable than chasing after get-rich-quick schemes. While speculative investments are like long shots with slim chances of success, investing smartly ensures your capital stays intact and grows over time. To become a skilled investor, you need a keen focus, a willingness to learn, and the ability to seek and follow expert advice. Remember, anyone can be an intelligent investor, including you, with the right approach and tools. Investing isn't some exclusive art form requiring special tricks or tools, nor is it just for the wealthy. In our fast-moving economy, investing has become a key part of building wealth, and owning stocks is something everyone should consider. However, be aware that many investors encounter problems due to poor management of their portfolios. You might come across someone with a diverse portfolio who still faces financial struggles. This underscores the importance of thorough research before investing in any stock. Making decisions based on solid data, rather than just emotions, is crucial. Being an intelligent investor is more than just investing or researching. It's about identifying the right stocks, knowing the best time to invest in them, and understanding when to sell.